In this video, we're going to look at leading indicators. So most technical indicators are used to try and help us decide what the market might do next. We've got lagging indicators, which are based on past data. And then there's leading indicators, which are aimed to be more predictive. I'm going to be honest with you, most indicators are lagging. And that is for obvious reasons, because it's obviously easier to analyze something which has already happened rather than try and predict something which hasn't happened yet, unless, of course, you are a fortune teller. But there are ways that you can use that lagging information to be a bit more predictive. And in this video, I'm going to talk you through a few ways that I use indicators in a leading way. So if you're excited to learn, hit the thumbs up button before we get started. And if you want to see more content like this, make sure to subscribe to Thinkmarkets now as well.
So the very first thing that we're going to look at is economic data. So there's many ways that economic data can be predictive. The first thing is that we know in advance exactly when the high impact news releases are going to be released. And we know that the exact second that that news data is released, the market will have this huge injection of volume into it, and it's going to go completely wild. Now, we don't know whether it's going to go wild up or down, but we know the exact time that it's going to happen, and then we obviously use the other tools that we have to help us distinguish what the direction is. We also know how the market is likely to behave 2 days before the news is released, the day that it is released, and also after it's released. So the very first thing that I will do at the start of each month is I will go to the economical calendar on Thinkmarkets, and I will look for the high impact news releases so I know what days they fall on. So for me, trading the US 30, that's NFP, CPI, and interest rates decisions. So those three pieces of news, I will know exactly what time they are coming out at. So you can see 1:30 CPI, and you can see exactly when that is coming out. That's UK time, by the way, so you don't get confused. And that helps me to plan the month ahead. So I know that at the second that that is released, the market's going to have a huge push in the direction of whatever the result of the news was. I also know that up to 2 days before, the market's going to be very difficult to get a good entry into, because what tends to happen before there is a piece of news release, you tend to get this very difficult condition. So sometimes the market will move in a clear trend, but a very difficult trend. So it's not a sweeping, clean, easy to enter into trend. It's more like a very, very choppy with very extreme pullbacks, very wicky candles, very difficult to actually get in without getting stopped out, whilst using a reasonable stop loss. What this can do is, first of all, it can tell you the days of the month in advance that are likely to be difficult, that are likely to be high volume, and then are likely to be easier. So depending on your skills as a trader, you can either avoid the difficult days altogether, also do other things, like you can use different strategies to get in when you know it's going to be difficult conditions. You can use smaller lot sizes to protect you under those circumstances. There's all sorts of things that you can do, but you know that information in advance. So we're just going to have a little look here. This was CPI, so this is when the news was released. So we saw that the market made a move up initially on the news release. It then made a huge move down, followed by another move up and another move down. That's very common on news days, especially if the news contradicts the long-term momentum. So at the time that this was released, the market on the day chart was having a bit of a push down. So the main move each day had been in a downwards direction. So the news release pushed the market up, it went up, but then it ultimately came back to its default and what it was doing on the day chart. What tends to happen the day after we've had a interest rate decision, CPI or NFP, is often it's a little bit easier. You tend to get some trends that are a little bit smoother, easier to get into. And that's just because the market has a little bit more certainty and a little bit more clarity. So for example, if CPI was released and it indicated that we might get a rate cut, you might start to see the US 30 moving up for a couple of days. In a way, you can use that information as predictive. Obviously, not everything happens the same way all of the time. You're just using information based on past data to help you get an idea of what might be happening. So the next thing we're going to look at is key levels. So key levels are price points on the chart where we expect some activity to happen. So very similar to news data in the sense that we know the time that the news is going to be released. So we know the time that you're going to get the sudden surge of volume into the market, but you don't know what direction the market's actually going to go in because we don't know what the news release is yet. The same thing with key levels. We know the price points where we expect some activity to happen. We just don't know yet what direction it's going to go in. So we have the points, and that is the first step. We know that there are often stop losses, stop hunts, liquidity sweeps, lots of orders at these points. So we know the points in advance that we're expecting activity to happen on, and then we analyze the price action when the market gets to those points. So I have made a whole nother video on Thinkmarkets YouTube channel going into price action at key levels. So if you're interested in that, make sure to watch that video next because it will talk you through what to look for at the key levels in a lot of detail. But a very short version of a long story is you're looking for wicks versus bodies of candles. So when I draw on a key level, I'm always looking for whether there is a wick which kind of rejects that key level, so perhaps you might get a reversal, or if the body breaks that key level. Again, there's another video on Thinkmarkets YouTube channel where I talk through where I actually put the key levels. But one example is I do use news data. So for example, this was a CPI day. So the high and the low of the big move which happens on a news day are great key levels. So you could add text to this and you can just call it CPI high. And then you know what that relates to. When the market comes back to this point, you can analyze the price action at that key level, and that can help to guide you going forward. Another cool tool which you can use, which behaves as a leading indicator, is the Fibonacci retracement. It's kind of like a cheat way of drawing on your key levels for you. So on US 30, the 618 point is the golden ratio. So that's the one that I'm really looking at. When I see a big move like this happening, rather than jumping in and being reactive to it, I wait for the move to finish. I grab the Fibonacci retracement tool. So on Think Trader, it's just along the side here. If you click the drop down menu, you can see all the different options. Fibonacci retracement. I then go from the top to the bottom, and then I wait for 618 to get hit. Sometimes I'll set a limit order. Sometimes I'll just do a market execution. Can you see how we had the wick of the candle at this level rather than a body breaking through it? So this is the sort of thing that I'm looking for to give me confirmation that I might want to come into a sell position. This was actually the best one. I saved it for last because it's probably the best leading indicator. Obviously it doesn't work 100% of the time. Nothing does, and you would always make sure you had a stop loss just above the top wick to make sure that you're not taking on too much risk. But the market does love this point. So the theory behind Fibonacci retracement is that because so many traders use it, it becomes like a self-fulfilling prophecy. So that is one of the best leading indicators, in my opinion.
So now you understand a few ways that indicators can be used in a leading manner. If any of these really resonated with you and you'd like to give them a try, the next step would be to head over to the Traders Gym on Thinkmarkets. It's a simulator, so it will allow you to test out any new strategy, indicators, or ideas that you might have, but you get to use virtual money first before going live. Also, if you got some value out of this video, make sure to give it a little thumbs up. And if you want to see more content like this, make sure to subscribe to Thinkmarkets now as well.